Good morning, participants. I hope you are all able to hear me. If you have any audio or video transmission problem, please raise your hands before we start today's session. So for revenue recognition under contract, we look at the last case study. So in the last case study, we'll look at use of both the input and the output method. Input method, as you know, is basically cost basis, and output method is basically sales basis. So we will see application of both input and output method in this particular case study. So that will make it clear to you how these two methods are applied and what could be the possible outcomes under the two different methods for revenue recognition under the same contract. Now, the entity here, AB Infra, has entered into a contract with a customer in the prior year. That means the contract was entered into last year. So AB Infra has entered into a contract with a customer in the prior year for building a multi-unit residential complex that is under construction. AB Infra has determined that the contract is a single performance obligation. It cannot be separated into separate performance obligation. So one single performance obligation which will be satisfied over time, not at a point of time. So it's a single performance obligation satisfied over a period of time. During the year we are talking of, the information given in the following table is gathered for the contract. Cost to date, cost incurred till date is 1,500. Future expected cost is another 1,000. Value of the work certified to date is 1,800 and expected sales value is 3,200. Revenue recognized in the earlier years is 1,200 and cost recognized in the earlier years is 950. So these are the 6 pieces of information available under the contract. We are required to calculate the figures to be included in the statement of profit or loss in respect of revenue and cost for the year ended 31st December on both sales basis, that is output method, or on cost basis, that is input method. So you look at these numbers and try to work out how much revenue should be recognized for the year ending 31st, for the current year, that is the year ended 31st December, how much cost should be recognized for the current year for the purpose of profit and loss calculation. Okay. Now, as we know, total expected sales value of the contract is 3,200. So revenue is 3,200. Cost incurred till date is 1,500, and future expected cost is 1,000. So total expected profit against sales of 3,200 and cost of 2,500. 1,500 has been already incurred and future expected cost is 1,000. So total expected profit is 700. So AB Infra will expect a profit of 700 from this contract. Now if you look at the measure of progress towards completion using both the output method, that is sales basis, and input method, that is cost basis. So we try to measure the progress of the contract towards completion using first output method and then the input method. On the sales basis, that is output method, 1,800 is the work certified to date. The value of the work that is completed up to 31st December of the current year is 1,800, and total expected sale is 3,200. So 1800 by 3200, 56.25% is the progress towards completion as per output method. As per cost, on cost basis or as per input method, total cost incurred is 1500, and up to date the total cost incurred is 1500, and total cost to be incurred on the project is 2500. So on cost basis, if we work out the progress towards completion, it works out to 1500 by 2500, that is 60%. So the measure of progress towards completion on the output method is 56.25, whereas the measure of progress towards completion on cost basis is 60%. Is that clear to everyone? Any doubts here, please express your doubts, because then we'll go to the calculation of revenue, how much revenue should be recognized in the current year and how much cost should be recognized in the current year using these two measures of progress towards completion separately. So no doubts? Please let me know if you have any doubts as to the calculation which you have done so far or shown you so far. Okay, apparently don't have any doubts because I don't see any raised hand. I'm still waiting. If you have any doubts, get it clarified now. Okay, fine. Now we will calculate a revenue cost for the year ended 31st December, that is for the current year. Using the sales basis output method, total revenue is 3200 from the project expected revenue or expected sales value. So if you measure the progress towards completion on sales basis or output method, total revenue is 56.25% of 3200 should be recognized, which is 1800. So 56.25% of 3200 is the total revenue, 1800. And cost of sales, 2500 is the total cost to be incurred on the project. So 56.25% will recognize as cost. So that is 1406, 2500 into 0.5625. Now for the prior year, revenue recognized till the prior year was 1200. So the revenue to be recognized for the current year is 1800 minus 1200, it is 600. Similarly, cost recognized till the prior year was 950. So the cost to be recognized in the current year should be 1406 minus 950, so 456. So profit would be, for the current year would be 144, which is 600 minus 456. So using output method, revenue of 600 would be recognized under the contract in the current year. Cost would be recognized at 456 for the current year, and the profit from the current year, under the contract would be 144. I hope this is clear to all of you, because we are now calculating revenue based on the measure of progress towards completion using output method. Similarly, we are calculating cost incurred till date using the measure of progress towards completion using the output method. And yes, from the revenue, we are deducting the revenue recognized in last year, so that will be the difference in the current year's revenue. Similarly, from the cost, we are deducting the cost incurred or cost recognized in the last year, so that difference will be the current year's cost. Okay. Under the cost basis input method, we will use a separate measure of progress towards completion, that is 60%, because we have already seen on the based on input method, the measure of progress towards completion is 60%. So revenue will be recognized at 3200 into 0.6, that is 60% of 3200, that is 1920, and cost will be recognized as 2500, total cost, expected cost multiplied by 0.6, that is 1500. Now since revenue recognized in the prior year was 1200, so the revenue recognized for the current year will be 1900 minus 1200, that is 720, and the cost recognized in the prior year was 950, so the cost to be recognized for the current year will be 1500 minus 950, that is 550, and the difference will be the profit for the current year under the input method, that is 170. I hope this example makes it very clear to you how revenue under a contract which is a single performance obligation and satisfied over a period of time has to be recognized using the output method as well as the input method. Any questions you can raise at this point of time? Anything, any calculation or any numbers which is not clear to you, you can always ask me the question. If everything is clear to you, I hope it is, then we can move on to the next lesson. Because this is the last case study we'll see under the revenue recognition under contract. So what we have learned here is contract. First of all, definition of contract. It's an agreement between two or more parties that creates enforceable rights and obligations. That output methods recognize revenue on the basis of the value to the customer of the goods or services transferred to date related to the remaining goods or services promised. Input methods recognize revenue on the basis of the entity's efforts or inputs to the satisfaction of the performance obligation related to the total expected inputs. Costs associated with the contract whose performance obligation is satisfied over time are expensed as and when they are incurred. They are not recognized on a proportionate basis. So now we'll go to the next lesson where we'll be discussing a very important accounting standard called IS 39, International Accounting Standards 39. It deals with one of the most complex areas in global markets known as financial instruments. So IS 39 basically deals with financial instrument, which is one of the most complex areas today in the global markets. Okay, so we will talk about the key position in IFRS on financial instruments, their classification and measurements. So we will try to understand and conceptualize the constituent element, that is financial assets and liabilities, understand and apply the accounting flow of transactions, understand the concept of recognition and de-recognition of the FIs, financial instruments, the derivatives and their significance and the difference between IFRS and US GAAP, so far as accounting for financial instruments are concerned. So as I told you, this is covered under IS 39, but several of the accounting standards also apply here. So you look at the applicable accounting standards or international financial reporting standards for financial instruments. Earlier there are traditional instruments, cash, trade debtors, long-term debt, investments, etc. But most of the entities today have moved from using the traditional instruments to highly sophisticated risk management strategies based on derivatives and complex combination of instruments. That's why it's a complex area. Earlier the entities are using only very simple kind of traditional instruments like cash, trade debtors, long-term debt, investments, etc. Now many of the entities have moved to highly sophisticated risk management strategies which are based on derivatives and complex combination of instruments. IS 39 is a complex area, so considering the scope of this particular course, we have basically limited the approach to learning this to the key areas and conceptual aspects of financial instruments. Some of the more complex areas will not be covered under this course, like de-recognition, derivatives and hedging. We'll simply introduce, but we will not get into much details regarding particularly into the depth of application. Now question is, what are the applicable international accounting standards or international financial reporting standards for financial instruments? There are numerous accounting standards that relate to this topic differently and also in parallel. So let's have a look at and have understanding in brief what all different standards are applicable for this topic and how they work in tandem. So what are the applicable IAS and IFRS relating to financial instruments? Let's look at all the relevant accounting standards or international financial reporting standards which are dealing with financial instruments. These are the basically applicable IAS or IFRS for the financial instruments. Number one is IAS 32, presentation of financial instruments. This deals with presentation of financial instruments. Then we have IAS 39, which we are going to discuss in details. Recognition and measurement. Now IAS 39 is going to be replaced by IFRS 9 from 1st January 2018, next year. IAS 39, which is currently in force or currently being used, will be replaced by a new reporting standard, IFRS 9. It is mandatory from 1st January 2018. It was introduced in July 2004, but it is optional. It will become mandatory from 1st January 2018. So IAS 39 will get replaced by IFRS 9. So it is basically, if you think about IAS 39, it is in transition, but it will be replaced by IFRS 9. And then we have got IFRS 7 relating to disclosures of financial instruments, disclosure requirements of financial instruments. So our main focus on learning will remain on IAS 39 and to some extent IFRS 9 and IAS 32. So here our main focus will be IAS 39 since it is still operative, and then to some extent on IFRS 9 the changes that will be brought about with introduction of IFRS 9, and also IAS 32 which relates to the presentation requirement of financial instruments in the various reporting statements. So IAS 32 basically addresses presentation requirements of financial instruments as either financial liabilities or equity or as financial assets. IAS 39 basically recognition and measurement addresses the accounting for financial assets and financial liabilities. IFRS 7 basically standard includes disclosure requirements of financial instruments and their assets and risks to be disclosed in the financial statements. And lastly IFRS 9 again for recognition and measurements, same as IAS 39. However, it will replace IAS 39 and become applicable from 1st January 2018. So different IFRS and IAS on FIs, financial instrument, talk about the following aspects. One is the overview and definition, second is presentation, third is recognition, measurement, classification, derecognition, embedded derivatives, age accounting and disclosures. So the 9 aspects are covered under the different IFRS and IAS. Of course, we will not be covering all the 9 aspects here. The scope of the course is limited to only a few of the aspects, particularly recognition, presentation, overview and definition, measurement, classification, etc. So this is basically a summary of the different aspects on which all the accounting standards IAS 32, IAS 39, IFRS 7 and IFRS 9 mentioned in the previous slides deals with. That is basically the scope of the standards. Here we will be covering classification, recognition, measurement and briefly understand the recognition, derivatives and hedging. So basically we will be looking at 6 of the aspects. One is classification, the other is recognition and measurement, and we will try to briefly understand also recognition, derivatives and hedging. Further detailed but the other details will not be covered for this course. So out of the 9 aspects, 6 aspects are going to be covered, and 3 in details and 3 in briefly. So first let's understand what are financial instruments. We have been talking about financial instruments, a very generic term. So what do we mean by financial instruments? Any contract that gives rise to a financial asset of one entity and a financial liability or equity of another entity is called a financial instrument. Any contract. The contract which gives rise to a financial asset of one entity and a financial liability or equity of another entity is called a financial instrument. Now, contract basically refers to an agreement between the two parties, which the parties have little, if any, discretion to avoid because the agreement is enforceable by law. So what I mean by contract is an agreement between two parties, and such an agreement the parties have very little discretion to avoid because this agreement or the rights available under the agreement is enforceable by law. An asset or liability need not always be contractual. So financial instruments, the asset or liability is a contractual asset or liability, or the equity is a contractual liability. But no, there could be assets or liabilities that is not contractual. So let's have an example. An asset or liability which is not contractual in nature. Can anyone tell me? Like obligation to pay income taxes. Is it contractual? Do you have a contract with the income tax department to that's so that you are obliged to pay income taxes? It is a statutory obligation. It is not a contractual obligation. It's a legal obligation, but this legal obligation arises out of a statute called Income Tax Act, a law of the land. So when an entity has the obligation to pay income taxes and the obligation is reflected in the financial statements or statement of financial position of the entity, that is not a contractual liability. So that will not come under the definition of financial instrument. Please understand difference between a contractual asset or contractual liability and a non-contractual asset or non-contractual liability. Like property, plant and equipment owned by the company. It's an asset, but it doesn't arise out of any contract. The company may have purchased the asset and is a owner of the asset. So there is no contractual, the asset has not been created because a liability has been created in another entity and the asset has been created in the books of this entity. So there are various kinds of assets and liabilities in the books of an entity. Some are contractual, some are non-contractual. So all liabilities need not be contractual liabilities. Some obligations may not be non-contractual. Like as I explained to you, liability or obligation to pay income tax is a liability which arises out of the statutory provision or under a statute that is called Income Tax Act. That is not arising out of any contract. So entity has to pay tax on its income, and that obligation is purely a statutory obligation, not a contractual obligation. So any contract that gives rise to a financial asset of one entity and a financial liability or equity of another entity is called a financial instrument. So let's have the definition very clearly in mind. It's an agreement which is enforceable by law between two parties. So neither of the parties have really any discretion or very little discretion to avoid these obligations. That is what is financial instrument. Now IS 32, which deals with presentation aspect of the financial instrument, it classifies financial instruments into 3 types. One we call FA or financial assets, the other is FL or financial liabilities, and the third is equity instruments. So there are basically Financial instrument encompasses equity instruments, financial assets and financial liabilities. These three terms all have specific definitions which you will see immediately after this slide. Each of these three terms, that is financial assets, financial liabilities and equity instruments, have got specific definitions which will help entities to determine which item should be accounted for as financial instruments. So broadly, financial instrument comprises of financial assets, three classes of financial instruments. One we call financial assets, one we call financial liabilities and equity instruments. Third is equity instruments. So what is the definition of a financial asset? Let's come to the first one, financial asset. A financial asset is any asset that is, first is cash, that is cash, or an equity instrument of another entity, or a contractual right to receive cash or another financial asset from another entity, or to exchange financial assets or financial liabilities with another entity under conditions potentially favorable, or that is contracts that may be settled in the entity's own equity instruments. So financial asset, there are alternative definitions. There are various types of financial assets. First one is the cash. Cash of course includes also balance held in the bank account, cash and bank balance. An equity instrument of another entity, if the entity has invested in the equity or shares of another entity, then the equity instrument of the another entity will be treated as financial assets. So all investments in shares of other companies will be considered as financial assets. Or a contractual right to receive cash or another financial asset from another entity, or to exchange financial assets or financial liabilities with another entity under conditions potentially favorable, or contracts that may be settled in the entity's own equity instruments. So we have a broad definition of financial assets: cash, investment in shares or other equity instruments issued by other entities, receivables, a contractual right to receive cash or another financial asset from another entity, that is trade receivables come under financial instrument, loans to other entities. When you give a loan to other entity, you will receive cash or basically from the other entity in repayment. Investments in bonds and other debt instruments issued by other entities. Derivative financial assets, to exchange financial assets or financial liabilities with another entity under conditions potentially favorable. So derivative financial assets will come under that category. Some derivatives on own equity. Example, let's say last one, contracts that may be settled in the entity's own equity investment. Similarly, financial liabilities. There is definition for the financial liability. A contractual obligation, any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial assets or financial liabilities with another entity under condition that are potentially unfavorable to the entity, or a contract that will or may be settled in the entity's own equity instrument. That is the definition of financial liabilities, FL. So a contractual obligation. Okay, some questions are coming up from Digba. Let me see. Derivative will not basically go into details. We'll talk about derivative subsequently, because the concept of derivative, it is not known to you at all. Then it's very difficult for you to, within the scope of this course, to understand that. Unless you have done some prior exposure to derivatives, it will be difficult. So we'll discuss some of the derivative financial instruments. We'll discuss when time comes. Derivative financial assets or derivative financial liabilities we'll talk about. Okay. In this particular case of financial liabilities, we are going to talk about derivative financial liabilities. We'll give you an example. So please Be patient. Let me see how much I can clarify on that. But I cannot go on clarifying what is a derivative financial instrument. That derivatives, I cannot go on basically what are financial derivatives and all that. We'll do it, but very briefly. That is not actually scope of this particular course. Will not allow me to expand more on derivatives. Please understand that. So let's look at the kind of financial liabilities. Let's look at some examples of financial liabilities like payables or trade payables. That is a contractual obligation to deliver cash to another entity. So if an entity has a trade payable or a payable, sundry creditors, whatever you call it, it's a contractual obligation to deliver cash to the other entity from which maybe the seller of rents or supplier of goods and all that. Loans from other entities, there is a contractual obligation to deliver cash or other financial assets to another entity. So that also applies in case of loans from other entities. Issued bonds and other debt instruments. If the entity has issued some bonds or other debt instruments like convertible debenture, etc., they have a contractual obligation to make payments to other entities who have invested in those bonds, etc. Derivative financial liabilities, obligations to deliver own shares worth a fixed amount of cash. Some derivatives on own equity. So we can look at the next slide to see an example of derivatives on own equity. Supposing Religer has an option contract to buy gold. So Religer bought an option contract to buy gold. If exercised, it will be settled on the net basis in Religer's own shares based on the share price at the settlement date. So Religer has entered into an option contract. Basically, Religer has sold an option contract, call option contract. This kind of contracts are settled on the net basis. It may be exercised, may not be exercised because it's an option contract. If it is in the money, it will be exercised, otherwise it will not be exercised. When it is exercised, it will be settled on the net basis and Religer has to pay in its own shares. So instead of paying by cash, Religer will issue own shares based on the share price at the settlement date. So Religer is the writer of the option contract, a call option contract in gold. Now if this call option contract gets exercised by the buyer, by the holder of the contract, Religer may have to pay the settlement, make the settlement on net basis. Now, how this settlement will be made? It will be made in Religer's own shares based on the share price at the settlement date. So the settlement amount is, let's say, 5 lakhs, which is basically calculated on the net basis. Then 5 lakhs have to be paid by Religer by issuing equity shares in favor of the contract holder, option contract holder, based on the share price of Religer on the settlement date. So this is a settlement in an entity's own equity instrument. Example of that. Third type of financial instrument, 3 classes of financial instruments we have talked about: financial assets, financial liabilities, and third is the equity instruments. An equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all its liability. So a contract which evidences a residual interest in the assets of an entity after deducting or netting off all the liabilities is called a equity instrument. So issued equity shares of capital of entity reflecting in the liability. So whatever shares have been issued, equity shares have been issued by an entity, it is reflected in liability side of the balance sheet in statement of financial position. That is example of equity instruments. Preferred shares, which provide for mandatory redemption by the issuer, a right to redeem by a holder, as classified as financial liabilities, not as equity instruments. Remember, company sometimes issues preference shares or preferred shares, which provide for mandatory redemption by the issuer or the right to redeem by a holder. These are classified as financial liabilities, not as equity instruments. So examples of equity instruments will include ordinary shares that cannot be put back to the issuer by the holder, Preference shares that cannot be redeemed by the holder or provide for non-discretionary dividends. There are different types of preference shares. Some preference shares which cannot be redeemed by the preference shareholders. There are some preference shares which can be mandatorily redeemed, or the shareholder or the preference shareholders have right to redeem. So those will be treated as financial liabilities, but preference shares which cannot be redeemed by the holder or provide non-discretionary dividends. They can be considered. Warrants or written call options. Sometimes companies issue warrants or options that allow the holder to subscribe for or purchase a fixed number of non-putable ordinary shares in exchange for a fixed amount of cash or other financial asset. So these are the examples of equity instruments which we call financial instruments. Basically, which are financial instruments in nature. So ordinary shares, some preference shares provided it is not redeemable by the holder and provides for non-discretionary dividends, which cannot provide for non-discretionary dividends. This dividends will be discretionary. That means company may decide how much dividend to pay. Warrants or written call options which allow the holder to subscribe for or purchase a fixed number of non-putable ordinary shares in exchange for a fixed amount of cash or another financial asset. So these are examples of equity instruments which come into the category of financial instruments. Now let's try to identify these financial instruments here. There is a small quiz. Let's apply whatever we have learned so far and try to understand which of these are financial instruments and which are not financial instruments. So let's start with the initial one, cash. Is it a financial instrument or non-financial instrument? Number one. And if it is a financial instrument, whether it's a financial asset or a liability or a equity instrument. So what is the response? Cash, the first item. Is cash a financial instrument? Yes. And it's a financial asset. Very good, Shivam. Thank you. Accounts receivable. Is it a financial instrument? Right. Shivam, correct. Shivam Jindal from Delhi Connaught Place. Accounts receivable. Okay, somebody is coming up with cash investment. What about account receivable? Let's go to the second one. Account receivable, is it a financial instrument? So I got the answers yes from two of you. Yes. So account receivable is also a financial instrument, it's a financial asset. Accounts payable, what it is? Is it a financial instrument and what it is? If it is a financial instrument, or it's a asset or liability or a equity instrument. So tell me, accounts payable. It's a financial liability. It's a financial instrument and a liability. So, investment in bonds, debt instruments or other entities. Is it a financial instrument? And if it is a financial instrument, what it is? Investment in bonds, debt instruments of other entities. Bonds, debt instruments are not equity instruments. Sorry. Investment in bonds, debt instruments of other entities are financial instruments and they are financial assets. Devale Manish, thank you. Investment in shares and other equity instruments of other entities. Again, whether it is a financial instrument and if it is financial instrument, then what it is? No, it is not equity. Investment in shares and other equity instruments of other entities are basically investments. These are financial assets, that's all. Okay. When the company issuing this equity instruments for the company, when the company issues the equity instrument, it's a financial instrument called equity. But when somebody purchases the equity of another company, shares of another company, for the holder of the equity shares, it's a financial instrument, it's an asset, not equity instrument. Inventories. Is it a financial instrument or not? So Dibya has come up with an answer. Okay. No. Inventories is not a financial instrument at all. Loans to customers. Is it a financial instrument? And if it is, whether it's a asset or liability, whether it's a FA or FL or equity, loans given to customers. Like a bank providing loans to their customers. Example. So it's a financial instrument and assets. Shivam Jindal, you are correct. Deposits from customer. Is it a financial instrument? Banks taking deposits from customer. Divya, you are correct. Yes, it's a financial instrument, it's a financial liability. Financial derivatives are the financial instruments? Yes, they are financial instruments. But whether it's an asset or liability will depend on the nature of the financial derivatives, whether the derivatives has been sold or purchased, depending on that. Whether the entity has purchased the financial derivatives or sold the financial derivatives, based on that will decide whether it's a financial asset or financial liability. But yes, financial derivatives are financial instruments. Current and deferred tax assets or liabilities are the financial instruments. Thank you, Divya and Shivam also, I believe, have given the same answer. Current and deferred tax assets and liabilities are resulting, they are statutory obligations. Okay, although they are obligations, but they are statutory obligation, not contractual, so they do not come under the definition of financial instruments. Commodity derivatives. Like financial derivatives, commodity derivatives are also financial instruments. Again, it will depend whether it's a financial asset or financial liability. It will depend on whether the entity has purchased the derivatives or sold the derivatives. Financial derivative contracts, again these are financial instruments. Treasury bills are the financial instruments. You know, companies, investors invest in treasury bills, entities invest in treasury bills. Yes, these are financial instruments. These are financial assets. Provisions made on doubtful dates. Next class is on Friday, not Monday. Provision made for doubtful dates are not financial instruments. Similarly, finance lease receivables are not financial instruments. These are covered under a separate accounting standard which we have already dealt with. Intangible assets are not financial instruments. This is also dealt with another accounting standard which we have already done. Similarly, property, plant and equipment, they are not financial instruments. So, last four, provisions made for doubtful dates, finance lease receivable, intangible assets, property, plant and equipment, these are not financial instruments. Now, somebody is inquiring from Amritsar Mall. Next class is Monday. First of all, you have not signed under your own student ID. Please understand, if you are not signing under your student ID, you will not be allowed to attend the class session. So please sign under student ID. Because I do not know your name. You are only a guest, appearing as a guest. So it is necessary, it's mandatory that you must sign with your student ID. And next class is on Friday as usual, not Monday. So classification, now we come to classification of financial assets. Having understood what are financial instruments, now we will talk about how to classify the financial assets. Now financial, under the IS 39, which is currently operating accounting standard, which will be replaced by IFRS 9 from 1st January of the next year. So we will talk first about your third cycle test is on Saturday, this Saturday. Seventh of May. Oh, sorry, so not 7th of May, sorry. 6th of May. 6th of May you will have your first third cycle test. Okay? Now under IS 39, there are 4 classifications of financial assets. 4 types of financial assets. So as an entity is required to classify its financial assets into one of these 4 categories. First is the financial assets at fair value through profit or loss account. This is called FVTPL. Financial assets at fair value through profit and loss account. FVTPL. Then held to maturity financial assets. Another classification. Another category. Then third category is the loans and receivables. And fourth category is available for sale instruments. So there are 4 categories. In one of these 4 categories, the financial assets must be classified. By the entity has to look at each financial asset and categories, put the financial asset in one of these four categories. So first category is the financial assets at fair value to profit or loss. This kind of financial assets requires accounting adjustments. These are generally held for trading. Designated as FVTPL, derivatives also fall under this kind of financial FVTPL category. Equity, bills, debt, loans held for trading, forwards, futures and options, all this come under the first category, financial assets at fair value through profit or loss. Second category of the financial assets are held to maturity financial investments. So non-derivatives, where there is an intention to hold till maturity, fixed and determinable payments are there, fixed maturity date are there, and active market exists. For loans and receivables, this category they are non-derivatives again. Fixed or determinable payments are there. Fixed maturity date is there, but there is no active market unlike in case of held to maturity financial investment. So there is no active market for this kind of financial assets. Loans and advances to customers, bank, balance with central bank, these are basically third cycle test. Again another guest is asking, why don't you sign with your own student ID? Gurgaon old DLF, some participant is making a query form which he has not signed under his own ID, student ID. There is an available for sale investment category. Under this there will be non-derivatives, non-trading, intention to hold long-term, designated as available for sale, long-term, treasury bills, equity, debt instruments, this come under this category. So entity is required to classify its financial assets into one of the four categories. One is the FVTPL, financial assets at fair value to profit or loss, held to maturity investments, HTM, loans and receivables, L&R, and available for sale financial assets, AFS. So we are talking of four categories, four classifications of financial assets here. The first one is FVTPL, second one is HTM, held to maturity investments, HTM, third category is loans and receivables, and the fourth category is AFS, available for sale. So one of these four categories should be considered for classification of each of the financial assets. The entity must classify the financial assets in its books into one of these four categories. That is as per the requirement of IAS 39. Okay. The first category, which is financial assets at fair value through profit or loss, includes all derivatives, financial derivatives, commodity derivatives, etc. Financial assets that the entity either holds for trading purposes or otherwise has elected to classify into this category. So basically financial assets which an entity is holding for trading purposes or otherwise has elected to classify in this category will come under this. Financial assets that are held for trading are always classified as financial assets at fair value through profit or loss. The financial asset is considered to be held for trading if the entity acquired or incurred it principally for the purpose of selling or repurchasing it in the near term, or is part of a portfolio of financial assets subject to trading. Trading generally reflects active and frequent buying and selling with an object to profit from short term. See, trading is different from investment. Trading is basically active and frequent buying and selling with an object to profit from the short term, whereas investment is not so much of frequent buying and selling. Investment doesn't involve very frequent buying and selling, but trading normally requires frequent buying and selling for basically objective is to make a profit, short-term profit. Financial assets other than those held for trading may also be classified selectively on initial recognition as financial assets at fair value through profit or loss. Okay. Then the second category, held to maturity investments. It includes financial assets with fixed or determinable payments and fixed maturity that the entity has positive intention and ability to hold till maturity. That means the entity is not holding these financial assets for the purpose of making short-term profits by trading. This category is intended for investments in bonds and other debt instruments that the entity will not sell before the maturity, irrespective of changes in market prices or the entity's financial position or performance. The third category, loans and receivables, includes financial assets with fixed or determinable payments that are not quoted in the active market. There is no active market for this kind of financial assets. Like entity may classify items such as accounts receivable, notes receivable and loan to customers in this category. Financial assets with a quoted price in an active market and financial assets that are held for trading including derivatives cannot be classified as loans or receivables. Please remember, financial assets which are quoted, have a quoted price in an active market and which are held for trading including derivatives cannot be classified as loans or receivables. And the last category, fourth category, available for sale financial assets, includes financial assets that do not fall into any of the other categories of financial assets or that the entity otherwise has elected to classify into this category. For example, an entity could classify some of its investment in debt and equity instruments as available for sale financial assets. Financial assets that are held for trading including derivatives cannot be classified as available for sale financial assets. So these are the four categories into one of which each financial asset must be classified by the entity. So four categories are FBTPL, HTM, LNR and fourth one is the available for sale. So the decision tree. Before classifying a financial asset into one of the four categories, there is a decision tree which will be followed by the entity to arrive at in which category a particular financial asset can be considered. So if the entity, this slide basically tries to make it clear how to classify. If the asset is held for short term, for taking profit, for making profit taking, it will be classified as held for trading. If not, it may be designated if it is at fair value through a profit and loss. That is elective. That is basically the entity may elect to consider the asset as designated at fair value through FBTPL, even if it is not held for trading for short-term profits. If it is not designated for trading at fair value through profit and loss, then it may be designated as available for sale, AFS. So it can be designated as available for sale investment. Otherwise, if it has a fixed determinable payments and there is an active market existing for those assets, then we see whether the asset has a fixed maturity date. If there is no fixed maturity date, then it can be again classified as available for sale investment. But if it is a fixed maturity date, then last thing we look at whether the entity has the intention, ability to hold till maturity and not subject to tenting rule, in which case it will be held to maturity assets. If the answer is no, then also it can be classified as available for sale investment. If there is no active market existing for the asset which has fixed determinable payments, then it will be classified as loans and receivables. So this is basically the decision tree which an entity may follow to basically classify the asset into one of these four categories: FVTPL, HTM, LNR and AFS. Is that clear? So entity can take help of the decision tree to decide an asset, financial asset, whether it should be in one of these four categories, in which particular category it should fall. So this is the classification of financial assets as per IAS 39. Now next comes measurement of financial assets. How the financial assets value will be measured in the books of accounts of the entity. initial measurement and subsequent measurement, both. But before we go for that, we'll have a short break here at this point of time. Then we'll talk about the measurement of financial assets, and then we'll go to the classification of financial assets under IFRS 9, which will be replacing IAS 39 from 1st January 2018. We'll come back after the break. Now we talk about measurement of the various types of financial assets. For financial assets which are classified as FVTPL, that means financial assets at fair value through profit and loss, initial measurement, that means when it is recognized, the first measurement will be at the fair value, subsequent measurements also will be at fair value. So FVTPL is measured at fair value on initial and on subsequent measurements, and any gain or loss due to the difference between the initial measurement and subsequent measurement is transferred to the profit and loss account. So if there is a difference between the initial measurement and subsequent measurement, supposing the company purchases some financial assets at fair value through profit and loss on 1st of October, they measure it at some initial value, whatever is the fair value at that point of time, and subsequently on 31st December on the reporting date, it will be again remeasured using the fair value prevailing on 31st December. The difference between the initial and the final measurement, subsequent measurement will be expensed or basically transferred to profit and loss account. For financial assets which are HTM category or held to maturity investments, the fair value will always include the transaction cost. In case of financial assets at fair value through profit and loss, the transaction cost will be expensed to profit and loss account. But in the case of other financial assets, that is held to maturity financial investments, loans and receivables, or available for sale investments, fair value should always include the transaction cost. Then for financial assets which are held to maturity type or loans and receivable type, subsequent measurement will be the amortized cost using effective interest method. But for available for sale investment, the subsequent measurement will be fair value or cost. So any difference between the initial measurement and subsequent measurement will be again transferred to the profit and loss account, as in the case of FVTPL. For FVTPL only, transaction cost is expensed to P&L. For other three types of financial assets, the transaction cost will be included in the initial measurement. In the fair value will include the transaction cost. So all other financial assets excluding FVTPL are initially measured at fair value with the transaction cost. The transaction cost gets capitalized, and subsequent measurement happens at amortized cost, whereas available for sales have subsequent measurements are all at fair value. So this is the IS 39 guidance regarding initial measurement and subsequent measurement of different types of financial assets. Now we come to IFRS 9. So we come to financial asset classification, IFRS 9. That is the one that will be applicable from 1st January 2018 mandatorily. So IS 39 is going to be replaced by IFRS 9 in another 6-7 months time. From 1st January 2018, it will be financial classification of financial assets will be as per IFRS 9. So in IFRS 9 there are basically two kinds of classifications instead of four. So a financial asset must be measured at amortized cost if the following conditions are met. That is the guidance of IFRS 9. The asset is held within a business model whose objective is to hold assets in order to collect contractual cash flows, and where these contractual cash flows are solely the payment of the principal and interest. So the amortized cost method would be used if these two conditions are met. Number one, the asset is held within a business model whose objective is to hold assets in order to collect contractual cash flows, and where those contractual cash flows are solely the payment of principal and interest. In all other cases, the financial asset is classified and measured at a fair value through profit or loss. So basically there are two kinds of financial assets under the new classification of financial assets under IFRS 9. One is financial assets at fair value through profit or loss, or financial assets where which will be measured at amortized cost. So the following figure represents the two approaches for classification of financial assets under IFRS 9. Financial assets measured at fair value through profit or loss, so VTPL, and financial assets measured at amortized cost. In IFRS 9, by classifying financial assets on recognition as one of the two types is a significant simplification over IS 39, because under IS 39 there are four classifications, whereas IFRS 9, which is being replacing IS 39 from 1st January 2018, there are only two classifications. One is financial assets measured at fair value through profit or loss, and financial asset measured at amortized cost. So it will make much easier when IFRS 39 will be introduced or become mandatory. The only two classification will make it easier to understand and apply, whereas IS 39 has four. So under IFRS 9, what will happen? The measurement of financial assets are to be classified into one of the two categories: FA measured at fair value through profit or loss, or FA measured at amortized cost. So for FA measured fair value through profit or loss, the initial recognition will be fair value. Subsequent measurement also will be fair value. Gains or losses due to revaluation or subsequent measurement will be transferred to the profit and loss or other comprehensive income. So Pratibha, you want the last slide? Okay. I will go back to the last slide once more and tell me when you are done. So the last slide is available on your screen now. So tell me when you are done, then I will move to the next slide to explain the initial measurement and subsequent measurement for the two classes of assets under IFRS 9. Okay, thank you. So coming to the measurement of financial assets under IFRS 9. Since there are two kinds of classification, we look at the measurement under IFRS 9 of financial assets. All financial assets measured at amortized at fair value through profit or loss. Initial measurement will be done at the fair value, and subsequent measurement also at the fair value on the date of subsequent measurement, that is the reporting date. The gains or losses, profit and loss due to the difference between the two measurements, it will be either transferred to the profit and loss account or other comprehensive income account. Like, entity might designate an equity instrument not held for trading to be presented to OCI. If the entity is holding some equity instruments, or invested in some equity instruments of another entity which is not held for trading purpose, this can be the difference between the profit and loss initial measurement and subsequent measurement can be, instead of transferring to the profit and loss account, it can be transferred to the other comprehensive income. For financial assets measured at the amortized cost, initial measurement will be fair value including the transaction cost. In case of financial assets measured at fair value through profit and loss, the initial measurement at fair value excluding the transaction cost. Transaction cost will be directly expensed to the profit and loss account. But in case of financial assets measured at amortized value, the initial measurement will be at fair value including transaction cost, and subsequent measurements on various reporting dates will be the amortized cost using effective interest method. The difference between the two, the initial measurement and subsequent measurement, will be again transferred to the profit and loss account. If ordinary shares or equity held in another entity for a long term or indefinite period, okay, can be irrevocably designated upon initial recognition as a VTOCI. So there is a third category. So under IFRS 9, we have got FVTPL, financial assets measured at fair value through profit and loss, or financial assets measured at amortized cost. Then we have a third category, financial assets measured at fair value through other comprehensive income. These are applicable for ordinary shares or equity shares held in another entity for long term or indefinite period. Of course, the amount of shares that is held in another entity, the quantity of shares held in the other entity should not be more than 20%. It should not be more than 20% of the equity shares of the other entity which has issued the shares. If it is, then IS 28 will apply, then IFRS 9 won't apply. Okay. So ordinary shares or equity held in another entity for long term or indefinite period can be irrevocably designated upon initial recognition as FVTOCI. They are measured in statement of financial position at fair value, and gains and losses are only recognized in the OCI, that is equity, other comprehensive income, but not through the profit and loss. So the intention at the point of recognition is the key issue. What is the intention of the entity at the point of recognition? Whether they wanted to hold the equity shares in the other entity for an indefinite period, or they just wanted to hold it for trading purposes. That intention is very important. That decides whether it should be FVTPL or FVTOCI. So measurement of financial assets or liabilities at amortized cost, how it is done? How amortized cost of a financial asset or liability is calculated? Initial recognition value, that is fair value plus transaction cost, minus principal repayments during the intervening period, that is between the date of initial recognition and subsequent measurement, plus or minus cumulative amortization using the effective interest rate of difference, cumulative amortization of difference, that is maturity amount minus initial amount, minus write down of the impairment or uncollectability. So that's how we arrive at the measurement at amortized, subsequent measurement at amortized cost. So how amortized cost of a financial asset or liability is calculated, we will see some examples. First is we started the initial recognition value, which is fair value plus transaction cost, from which you deduct the principal amortized. Amortized means basically how much has already been paid out. We will see. Let's look at an example, then we will understand. When you look at an example, then we will look at the cumulative amortization, what does it mean. So, we will see an example to make it clear. This is how it is calculated. And write down for impairment or uncollectability can be adjusted. If there is a write down involved, that can be adjusted also to arrive at the amortized cost. So we'll find an example shortly. Now coming to income, gains, expenses and losses associated with the financial instrument. Actually amortization, if I explain here, in the context of financial accounting, it becomes very difficult because this is a financial concept. A loan gets amortized, what does it mean? When a person who has taken a housing loan from the bank will reflect that housing loan given to the customer as a financial asset at amortized cost. Okay. Now amortization, what does it mean? The person is paying the EMI. When he pays the EMI consists of both principal and interest components. Now as he goes on paying the EMI, the part of the principal gets repaid. That is called amortization. Okay. So we'll talk about income, gains, expenses and losses which are associated with the financial instruments, how they are recognized. So what are the various kinds of income, gains, expenses and losses associated with the financial instruments. One is interest and dividend. So if one has invested in financial assets like bonds, etc., he earns income. If one has invested in equity shares, he gets dividend. So that is one kind of income or gains. Or it can be also expenses, because when a company has issued bonds or debentures, it has to pay interest. That is a expense. That is a financial liability, and the expense associated with the financial liability is the payment of the interest. The losses or gains on subsequent measurements that we have talked about, between the difference between the initial measurement and subsequent measurement can result in losses or gains. Then there can be transaction cost. There can be impairment loss. The carrying value of the financial asset or liability in the books can be different from its fair value. That is called impairment loss. And then settlement gain or loss, when the financial instrument is eventually sold out, there could be settlement gain or settlement loss. So the slide basically talks about various income, gains and losses that can occur through a financial instrument. Example, dividend on equity investment of another company, that's an income. Gains or loss on settlement of trading financial instrument measured at FVTPL. So entity is trading in financial instruments, so the gains or losses on settlement of trading financial instruments, which are measured at FVTPL. Loss on impairment of a financial asset. These are the kinds of income, gains, expenses, losses which are associated with the financial instruments. Loss or gain can also arise due to subsequent measurement on the balance sheet date for financial assets at FVTPL. If a financial instrument, now treatment of interest and dividend, how it is treated in the books of accounts. Accounting treatment for interest and dividend. If a financial instrument is classified as a financial assets or financial liability, interest, dividend and losses or gains on a subsequent measurement is recognized in the profit and loss statement as income for financial asset and expenses for financial liability. Now there is a small quiz. Can you identify examples of financial liabilities requiring interest and dividend payment? Can you give me an example of financial liability requiring interest and dividend payment? Like bonds issued by an entity, debentures issued by a company, these are examples of financial liabilities requiring interest payment. If an entity has issued bonds or debentures, then they have to pay interest to the bondholder or the debenture holder as per terms or indenture of the bond or debenture. So this the financial liabilities requiring payment of interest. Similarly, equity instruments issued by an entity will require payment of dividend, like preference shares or ordinary shares issued by an entity, and the shareholders will be paid dividend. So these are basically financial liabilities which require dividend payments. Preference shares is an example. Now coming to transaction cost. If it relates to a financial asset or financial liability at an amortized cost, transaction cost will be always capitalized to initial cost of financial or financial liability. If there is a transaction cost involving a financial asset or a financial liability which is measured at an amortized cost, then they will be capitalized added to the initial cost of the financial asset or financial liability. But if it relates to a financial asset or financial liability at a fair value through profit or loss, then they are expensed in the profit and loss to the profit and loss account. So they are written off in the profit and loss as an expense. In the year the transaction cost was incurred. So transaction cost may arise in the acquisition, issuance or disposal of a financial instrument. Transaction costs are incremental costs such as fees and commissions paid to agents, advisors, brokers and dealers, levies by regulated agencies and security exchange, and transfer taxes and duties. So these are normally capitalized by adding it to the initial measurement of the financial asset or liability. Like entity A purchases 100 shares of entity B with a quoted price of $124 at a total consideration of 12,400. Let's say entity A purchases 100 shares of entity B. The quoted price is $124 per share, so total consideration for 100 shares is 12,400. In addition, entity A incurs transaction cost in the form of broker fees of $100 to acquire the shares. So entity A will classify the shares at fair value through profit or loss. In this case, entity A would make the journal entries as on initial recognition, something like that. So the example is, A purchases 100 shares of entity B at $124 per share. Brokerage paid is $100. Now this investment this investment made in the entity B shares classifies the investment or the financial asset at fair value through profit or loss. So on the date of acquisition of the shares, entity A will debit financial asset at fair value through profit and loss. They will debit 12,400, debit fee expense, that is brokerage or fee expense or brokerage, $100 and credit back or cash 12,500. This is the journal entry. The fee expense will be ultimately transferred to profit and loss account when the entity closes its books. So the initial recognition or initial measurement of the fair value through profit and loss for this 100 shares will be only 12,400, not 12,500. The transaction cost will not be included here. Okay. Then comes the concept of impairment. Impairment criteria, as we know, a financial asset or a group of financial assets is impaired only if there exists an objective evidence of impairment as a result of one or more events that occurred after the initial recognition, and the loss event has an impact on the estimated future cash flows. So the impairment loss is taken as difference between the asset's carrying value and present value of the estimated future cash flows discounted at an original effective interest rate. So how we calculate the impairment loss? The assets carrying value in the books of accounts minus present value of the estimated future cash flows discounted at the original effective interest rate. That is how impairment loss is calculated. So objective evidence of the impairment is carried out at the end of each reporting period. What are the objective evidence of impairment? There can be payment or payment defaults. That is one of the objective evidence of impairment. Significant financial difficulty faced by the issuer of the instruments. Restructuring due to bankruptcy or a financial difficulty. There could be disappearance of an active market for the assets concerned, or measurable decrease in estimated future cash flows. These are the objective evidence for impairment, which are basically at the end of each reporting period, the entity will look for any objective evidence of impairment, which could be any of these, like payment default, significant financial difficulty faced by the issuer, restructuring due to the bankruptcy or the financial difficulty faced by the issuer, disappearance of an active market for the assets concerned, or measurable decrease in estimated future cash flows. So we'll look at a study on financial assets at FVTPL to understand a few concepts which I've discussed here. In January 2012, FVPLC purchased 10 million $1 listed equity shares in Hall at a price of $5 per share. So REV PLC purchased 10 million, $1, each equity share has a face value of $1. These are listed in a stock exchange, issued by Hall. Hall is the name of the company. The price paid by the entity is $5 per share when they purchase these 10 million shares. Transaction cost was $3 million. REV PLC's year end is 31st December. As at 31st December 2012, the shares in Hall were trading at $6.50. On 31st October 2012, REV PLC received a dividend from Hall of 20 cents per share. So the financial statement extracts of REV PLC as at 31st December 2012, referring to the investment in Hall on the basis that the shares were bought for trading. That means this financial assets is measured at fair value through profit or loss. Shares have not yet been sold. So how REV PLC will treat this dividend income, will treat the subsequent measurement of the financial assets in its books at the time of closing its books on 31st December 2012. So we will try to see the solution. So let's look at the solution available in your listing. No, not this one, sorry. This is another different case study. So this is the one. So the shares were initially recognized at $5 per share. Now, as on 31st December 2012, shares which were purchased at $5 per share, the fair value is $6.50. The difference, $6.50 minus $5, that is the difference between initial measurement and subsequent measurement. So 10 million into 1.5, that is basically transferred to the profit and loss account. So the profit and loss for the year from investment income will be 10 million into 6.5 minus 5.0, so 15 million. Dividend income has been earned from this 10 million shares at 20 cents per share, so 10 million into 20 cents becomes 2 million. So investment income in profit and loss account will be 15 million from the investment in the shares, 2 million from the dividend. Transaction cost, while purchasing the shares, 3 million of transaction cost was incurred, so 15 plus 2 minus 3. So the profit basically will be 14 million. Statement of financial position in the balance sheet, the investment in equity instruments will be shown at 10 million into 6.5, 65 million. Initial measurement was 10 million into 5, so 50 million, but the subsequent measurement on the reporting date 31st December 2012, the investment in equity instruments will be shown at 10 million into 6.5, that is the fair value on the date of reporting or statement of financial position. Is that clear to everyone? This is a very simple example. So this is a financial assets as fair value through profit and loss account. Here the transaction cost will be directly charged to the profit and loss account. It will not be capitalized. So the initial measurement will be 10 million into $5 per share, so 50 million, that will be the initial measurement. Subsequent measurement will be 65 million, 10 million into 6.5. The difference will be transferred to the profit and loss account as an investment income. So 10 million into 6.5 minus 5.0, 15 million. Dividend income earned from the shares because the company hall declared 20 cents of dividends per share. So as a holder of 10 million shares, ABPLC receives a dividend income of 10 million into 20 cents, so 2 million, and the transaction cost for purchasing the shares is 3 million. This will be reflected in the profit and loss account. In the statement of financial position or balance sheet, the investment in the equity instruments will be shown at the subsequent measurement of 65 million. I hope it is clear to all of you. Very simple example. Is that clear to everyone? If any doubts, please express it, because now we'll be seeing some examples involving amortization, fair value, financial assets at amortized cost. So let's look at the second example, which is financial asset at amortized cost. We'll see two examples actually. One is the first example of financial asset at amortized cost. Standard Bank PLC purchased a loan on 1st January 2014 and classified and measured in compliance with IFRS. So the bank purchased a loan on 1st January 2014 and classified and measured it in compliance with IFRS. Terms of the loan, nominal value was 50 million, fixed interest rate is 10%, term to maturity, remaining term to maturity is 3 years, first purchase price was 48 million, and effective rate is 11.67%. Do calculation and accounting till the date of maturity. The loan is going to mature on 31st December 2016 because 3 years are remaining. The purchase was made on 1st January 2014, so another 3 years term to maturity is there. So the loan will mature on 31st December 2016. So we'll have to do the calculation and accounting till the date of maturity. We have to remember a few numbers. Nominal value of the loan is 50 million, but the loan was purchased for 48 million. That was the time. That was the fair value at the time of purchasing the loan. Interest rate, the interest paid on the loan is 10%. So every year, Standard PLC will receive 5 million of interest on the loan for 2014, 2015 and 2016. But the effective rate of interest is 11.67% and amortization has to be done using this rate. Okay. So let's see the solution to this case. So everything is expressed here in thousands instead of million, just to reduce the number of zeros. So 50 million means 5,000. Okay? 50 million is 50,000 really speaking. 50,000 followed by 3 zeros. So instead of, we are dropping the last 3 zeros in all the calculation. So 50 million will be considered as 50,000. 48 million will be considered as 48,000. Now Standard Bank PLC will receive interest of 10% on 50 million, that is 50,000 here. So 5,000 or they will be receiving as interest each year. And when the instrument matures, that is after 3 years, that is on 31st December 2016, they will receive 50,000 as the principal amount, isn't it? The loan is for a term of remaining term of 3 years. The loan was purchased on 1st January 2014, it will mature on 31st December 2016. For the year 2014, 2015 and 2016, for each of these years, Standard Bank PLC will receive 10% interest on the nominal value of the loan or face value of the loan, which is 50 million or 50,000 we are taking at. Okay. So 50,000 into 10%, that is 5,000 will be the interest flow, interest payments which will be received by Standard Bank PLC each of these 3 years. And at the end of the loan term, that is on maturity of the loan, on 31st December 2016, they will receive a cash flow of 50,000 when the instrument matures. Now Standard Bank PLC, how much is the discount for the loan? The loan has been purchased for 48 million although the nominal value of the loan is only 50 million or 50,000. So loan has been purchased for 48,000. That means a discount of 2,000. Now this discount must be allocated, and the interest receivable over the 3-year term will be allocated at a constant rate on the carrying amount of the debt. To do this, it must apply the effective interest rate, which is given as 11.67%. So the table shows the calculation and allocation over the years. In 2014, the amortized cost at the beginning of the year was 48,000, which is 48 million. Because last 3 zeros here, we'll see the last part of the slide so as I move up. Okay, don't worry, Dibba. So let's finish with this. Okay, let me move it a little up. Can you see it better now, Dibba? I hope you can see it better now. Okay. In 2014, amortized cost of the loan at the beginning of the year was 48 million. That is the cost at which the loan was purchased. So on 48,000, interest income at 11.67% is 5,600,160, but the interest actually received during the year is 5,000. So the difference adds up to the amortized cost. The amortized cost goes up to 48,601.60 at the end of the first year. Then amortized cost at the beginning of the second year, that is 2015, is 48,601.60, and profit and loss or interest income on the amortized cost using the effective interest rate is 5,671.81, that is 11.67% of 48,601.60. But actual interest received during the year is 5,000. So the difference 671.81 adds to the amortized cost, and the amortized cost will now become, here the calculation is a little wrong, the amortized cost will become 54,273.41. That calculation has been shown wrongly. 54,276.41. There is a mistake of 5,000 here. Okay. So the amortized cost at the beginning of 2060 is 54,273.41, and interest at 11.67% on this amortized cost at the beginning of the year. The interest will be, I think there is also a mistake in this calculation, 54,273.41 multiplied by, can anyone do it? 54,273.41 into 11.67%, how much it comes to? Anybody else done the calculation? 6333.70. I think that is correct. So it should be 6333.70. So interest received during the year cash inflow will be again 550,000 plus 5,000. So when you add 54 to 7341 plus 6333.70, I think Pratibha has got the correct answer. Arithmetic is also very similar to that. Very close to that. Let me take Pratibha's answer. I think Shivam, we are calculating on 59,000, not 59,000. It should be calculated on 54,000 to 73.41 because that number is wrong. The correct number is 54,000 to 73.41, which is the amortized cost at the beginning of the year 2016. So apply 11.67% on that. So it comes to 6333.70. So 54 to 73.41 plus 63.70. It will give you almost there is some mistake here in the calculation, I am very sure. Okay, 48,5601.60, this is correct. 5671.81, so sorry, this will be 49,273.41. Let me see, 48,601.60 plus 671.81 will give you 49,273.41 is the amortized cost at the end of the second year. That was the mistake. 49,273.41 was the amortized cost at the end of the second year, not 59,000. It is higher by 10,000. It is higher by 10,000. So the correct amount of interest at 11.6% on 49,273.41 will be 5750.21, correct. So 49,273.41 plus 5750.21 gives you 55,023.62. So the amount of interest, that is interest received during the third year, is again 5,000 plus 50,000. So almost it is equal to the entire cost gets amortized. So the amortized cost at the end of the year at the beginning, during the year 3, after you include that 5,750.21 added to 49,273.41, it becomes 55,000 almost. And the amount of cash flow, this 50,000 received on maturity plus 5,000 interest received on during the year 3, that makes up that the loan gets fully amortized. That is how the amortized cost is calculated from year to year. So you have to use the effective interest rate. You have to take the amortized cost at the beginning of each reporting period and apply the effective interest rate for calculating what is the interest income on the amortized cost and how much interest is received during the year. So after adjusting with the interest received during the year, that's cash inflow, you will get amortized cost at the end of the year. This is the way the amortized cost is calculated, and subsequent measurement is made. Is this clear to everyone? So when you add 49,000 to 73.41 at 5,750.21, you get 55,023.62. Almost 55,000, very approximately 55,000, and 50,000 is the cash inflow from the maturity of that loan, and 5,000 is the interest, cash inflow through interest on the loan for the year 3rd year. So that makes up the total amortized cost at the beginning of total amortized cost. So the loan gets repaid. This is the way the amortization or the fair value at amortized cost is calculated from year to year. The value at fair value at amortized cost will be calculated for those assets which are classified as under fair value at amortized cost. This is the way it should be calculated. We will see another example maybe in the next session to make it very clear to you. This is one example I have already given you. So I'll request you to provide the feedback as we are approaching the closing time.